Hello, this is Mike Swanson of WallStreetWindow.com. I'm speaking with David Skarica, who runs the website addictedtoprofits.net. How you doing today, Dave?
Good, Mike. How you doing?
Oh, great. Thanks for having me and joining in this podcast, taking time out of your schedule today. Well, it's Tuesday as we're doing this, December the 20th. We've only got, another week, basically, to end the trading year. You're looking for anything to happen between now and New Year's?
No, I think we're kind of in this holding pattern. It looks to me that even though the market's very overbought, we have a lot of bullish sentiment. We're kind of, we've both been around long enough is that I remember Dow 10,000, right? Back in 99, 2000. And it was the same thing there. The market was kind of going parabolic. It was going straight up. It was near the end of a bull market. But there was enough momentum there to get the Dow above 10,000. Actually ended up going to 11,700 during that top. So I'm not saying we're going to go another 15 or 20% higher after we break 20,000, which would be 22 or 23,000 on the Dow. But I definitely think we're going to have enough momentum here to go through 20,000, and then can kind of get going and then see what happens from there. I definitely think we need some kind of correction to gauge what's really going on, because I look at all my indicators, for stuff like investors' intelligence or the RIDEX ratio, which shows where people are actually putting their money in bullish or bearish instruments. So I look at those, or whatever the indicator. And there's another indicator I watch called the NAME, which shows where fund managers are putting their money. They're almost all showing extremes amount of bullishness and people being overinvested in stocks at the moment. So you're probably going to need some kind of shakeout. So the way I'm doing is really quite simple. I'm just kind of adding to my hedges and the bear funds as the market strengthens. And I have I just bought actually two more companies, and I kind of bought these beat up companies that I think can be like turnaround plays. And also a lot of these companies are down 80-90% from their all-time highs. So they obviously have not participated in the market rally. So my feeling is if they can kind of turn around some of their own individual prospects, they can rally even if, there's a 10-15% correction in the market. So that's kind of the way I'm playing it. I'm just adding to these beaten up companies. And adding to some bear funds as hedges, etc. And I will be adding to some shorts in the new years. I have an option trading service, and every year I like to start off with some new option trades. And what I'm going to do this year in particular, though, I'm not going to try to trade anything short-term in options. I'm just going to buy January 2018 either puts or calls on certain companies and just start my option portfolio like that. And again, be hedged. Hopefully, if the market does tank, some of these puts will do really well, and a couple of these companies can do well on the call side. And I'll probably do a couple of what's called straddles, where you buy a put and a call on the same company. So then the idea with the straddle is, as long as that company can see a huge move. So let's just say you buy this company, you buy the put and a call, and the company doubles or triples, but that option is probably going to go up 3 or 4 times that. So a double of the company, you'll probably see the option go up 5 times in value or something like that. And, well, do the math. If your call goes up 5 times and your put goes to 0, you've made 2.5 times on your money, right? So you're still going to make money that way. So, but the key to a straddle is you need a big move. You can't just have the stock sitting there. So I'm going to do the straddles on some stocks, which I think are going to move a large amount either way.
Well, when you do the straddles in that strategy, you're looking, are those options going to be priced out in the future too, or are you trying to do short-term straddles?
No, I'm doing all long terms to start the year. That's the idea. It's a trend for the year.
Oh,
and see, the thing when you give yourself that kind of time limit, usually when you do a straddle, you'll do an at-the-money option. So let's say a stock is trading at $10. You'll do a $10 put or a $10 call, if this option expires in a month or two. But if you got a year out, what I like to do then is, because I'm just looking for a big move, I'll buy the put. It's not a pure straddle. It's a straddle where I'm buying like the call, say 20% out of the money or 10% out of the money, and the put 10 or 20% of the money. So you're going to have more leverage in that individual option if the stock moves a lot, but you're going to need a move. Like if the stock just sits there, you're not going to do well. Let me give examples how this could have worked last year. Me and you we've traded these casino stocks in the last few years, right? And last year, Wynn, for example, it began the year, it had really been beaten up. Macau was doing very poorly. Wynn has a lot of debt. I think at some point it is going to have financial problems in the next economic downturn. So let's say you would have thought that was going to happen in 2016. Well, you could have bought a put on Wynn, say at $40, but to hedge your position, and could have said, well, Wynn was really beaten up. It's gone from $250 to $50. So maybe we'll have a big bounce. You could have bought, say, a $60 call. Well, Wynn doubled in price to actually, I think as high as 108 or 109 a share. Right now it's trading at 90. So if you would have bought that call, would have done very well. The put would have gone to zero, but you would have made money on that trade because of the big rally in Wynn, right? So that's kind of what I'm looking for. I'm looking for these stocks that can have a big move in either way. Because like I said, the basic math is as long as you get a more 100% move on one of the two options, you're going to make money, even if the other option goes to zero. Actually, I'll give you another example. I did a straddle recently where I really lucked out. I was short and long in the newsletter options. You know, Skechers, the shoe company.
What's and again, the symbol? This is SKX?
SKX. Now, this is a stock that now we covered the short of the newsletter, and I'll tell you what happened really funny with the option. Was this is a stock that we had went short in the 50s in 2014, and it's had a really, really bad was it 2004? No, sorry, 2015. So it had a really bad year and had gone down into the low 20s. So in the low 20s, I was like, you know what? This stock is now cheap enough and beaten up enough. Might have a good rally on its next earnings. This was in November. So I bought some Januaries in the newsletter. So the stock, I think, was about 23 or 24 at the time. And I bought some January 25s and on the call side, and I bought some January 20s on the put side. And amazing enough, the stock gapped down to 19, so people could have sold their puts and made money. And then the CEO bought a ton of stock, and the stock then had a huge rally on it. And then the stock went to 27, and we sold our calls there.
That's great.
And I was able to, so on that case, I was able to, someone could have made money on both trades. So, you know, that's kind of too why I like to go further out. We're talking about doing Jan 2018s, starting, say, in a few weeks here. The reason I really like to do that is because if you go further out like that, you have time for like that trade I just mentioned to you. What happened then was because I did January 2017s, and this was in November, you know, I had 3 months or 2.5 months. I had time for the stock to go below my strike price on the puts in the newsletter and then go above my strike price on the calls. So that's why I don't like to play these really short-term options. I know it's easy to look at all the money you can make if there's a huge move in a stock. Like, let me give you another example. It's actually Skechers again. In November of 2015, it was probably my largest short in puts because the stock has about the most parabolic chart you've ever seen going into its top in the summer of 2015. So I was convinced then this thing is just going to crack big time. So it gapped down like 30% on its earnings in its November earnings of 2015. And when that happened, I was looking at some of the short-term option change, you know, the ones that like a week or two out of the money. Some of these puts that were, say, 20% out of the money that had basically assumed they were going to close totally out of the money and at zero, they were up, 10, 20, 30 to 1, 10, 1,000, 2,000, 3,000%. So it's always easy to say in 2020 hindsight, you look at that, oh my God, if I just owned a couple $1,000s of those. But the problem is 99% of the time you're going to lose everything if you do that. So I like to buy these further out of the money trades. And see, we've talked a lot about rebalancing your portfolio. So if a sector goes down, you can buy more to balance, average down into it. If it goes up, you sell some and you rebalance. It's like if you have two stocks and one goes up 20% and it's worth $24,000, and one goes down, say 10%, and it's worth $18,000. Well, you then can rebalance where now your $40,000 is worth $44,000 or so $42,000. Now you could rebalance and buy 21,000 each stock. So you can sell 3,000 in one and buy 3,000 in the other. So that's what rebalancing does, and it really keeps your performance in the long term steady. So what I'm going to do with my options this year is probably every quarter or so I'm going to rebalance. I'm going to start with a certain amount of these puts and calls that expire in January 2018. And let's say there's a big dump like there was last year in the first 2 months of the year. Well, then what I'd probably do is sell some of the puts at a profit, buy some more calls, or maybe transfer the puts to other companies that I think can still fall the remainder of the year, etc. So I'm just going to rebalance that all year. And I think this is kind of an experiment I'm doing this year. But I think what will happen with this, if there is a big dump in the markets this year, what will happen, I think, with this strategy is if there's a big dump, you're still going to make a ton of money because you're going to get the premiums spiking in the options. These companies are really going to fall hard. And if there's no decline in the markets and these calls work out, I think these calls will make up for the puts expiring worthless. So this is kind of an experiment I'm doing where, if you're using the puts just as a hedge, you're actually, this is kind of funny when I say this, you're hedging your hedge. You're basically making it so maybe you don't lose money on this option trade. But what ends up happening is if there's still a big dump, if the market stays steady, it goes higher. But if there's still a big dump in the market, you're going to make a lot of money on the puts and on the premiums and going higher and whatever. Like, let me give you another example of a stock that I lost money on this year. I got no problem admitting that. Is I think NVIDIA is probably the biggest bubble stock out there. So I'll give people a pick then, right? And the disclosure is I do own some January 2018 puts on this. Okay, so NVIDIA, if you go look at the chart, it's gone straight up. Yahoo Finance just made it their company of the year. And this is a stock that has a history of booms and busts in business cycles. So last year, the mistake I made, and this is where I learned from mistakes like everyone else, is I didn't buy any calls as a hedge because I was just so convinced NVIDIA, at $50, $60 a share was a bubble. Well, now it's $100 a share. So what you could have done last year is you could have bought some calls on NVIDIA, bought some puts, and same thing. NVIDIA went from, I think, about $30 to $40 to over $100 right now. So the calls would have made you a lot of money, and you wouldn't have cared that your puts expired worthless, right? So that's kind of what I'm going to do next year is I'm going to look for some stocks that I think can have moves big in each direction. And if you get a big move, you're really not going to care about one of those positions going to zero. Because remember, this is the nice thing about an option as opposed to, say, shorting a stock. You can lose more than you put in when you short a stock, right? If you would have shorted NVIDIA at 40 and the stock is 100, you could actually lose 150% of your money. But if you just bought the option, you just lost 100%. So the nice thing about that option trade is if a stock collapses, you make hundreds and 100% on the put, you're not going to care that you lost money on the call. So this is kind of like strategies that I'm using for this year. And I think what I like about these strategies is, look, I've been bearish on the macro market since 2014. And the bubbles kept getting bigger. There's that old saying that the market can remain irrational longer than you can remain solvent. So I've kind of gotten sick now of, always being worried about a collapse. And I'm looking for a strategy where it's more market neutral. I can make money. And if the market still has this collapse that I'm worried about, and I still think that will happen either within the next 2 to 3 years, then I'm still going to make a great deal of money. In that scenario.
Well, you were speaking of buying puts and the straddles in positions in January. What kind of market drop would it take to make that become a huge profit? Would it take a 10% drop or 15 or 20 or? Well,
yeah. See, here's the thing: if you get a real crash, like an '87 type crash, you are going to make an enormous amount of money because of the premiums.
Yeah.
So the way a lot of these options get priced is, you want the VIXs. We've talked about the VIX in the past. Is if the VIX is 12 and in a crash it goes to 50, it's gone up 4 times. That means the premium on your put options is probably going to go up 4 times. So just think of it this way. Not only does your stock go down to your strike price, but the premium also goes 4x. That's why some of these put options can go up 20, 40, 50, 100 times in a crash. And that's how Martin Zweig made a lot of money in put options during the 87 crash, because he had puts on the S&P. So not only did the market go down below his strike price and he was in the money, but then the premiums on those options went up like crazy, right? So what I found is in the last 2 years now doing this, so someone who decides to eventually join my service and participate in this kind of trading, as I've learned now from 3 market corrections: the October 2014 correction, this correction summer last year, and the correction of early 2016. And what I found in all those corrections was, you see the premiums jump up, and a lot of my options went up 100, 200, 500% during those corrections, just on a 10 to 15% correction in the stock market. So I really think someone can make a lot of money in just a correction, but I think what you got to be as prudent is you can't be greedy. So if you get those kind of corrections, you can sell a third or half your positions in the puts, and if the market crashes, you're still going to make a lot of money. But if it doesn't and it rallies back higher, well, then, you've really cut the potential losses when it rebounds like that. Now, I like the put strategy now because the one problem I always had in the back of my mind, and it was that, we're in an election. I do think the Federal Reserve and whatever, they're trying to get Clinton elected. They wanted to prop up the markets into the election. But now we got Trump in power, and I definitely think that the people at the Fed or whatever, they don't like him. So they're less inclined now to even care. So I think that also, makes it more possible for, a market to tank. And I also think just Trump's policies are more market orientated in terms of what his inside crew is going to try to do. So that also makes this more of a real stock market, a real market that's going to have volatility, not be what I call this market of hyper-normalization. And what this market was, just to finish off on this note, see, the problem I had, even though I was buying puts, was we needed the hyper-normalization to end. So you may ask, what's hyper-normalization? Well, this guy named Adam Curtis in the BBC, he made this great documentary recently on hyper-normalization in kind of the kind of world that we live in today. And what the term was invented is in the 1970s, everyone in the Soviet Union, a lot of the people in the Soviet Union, knew the system was a joke. They knew that the economy was getting worse. They knew that it wasn't working anymore. So they knew that it was almost like fake in a way, that they didn't really believe in it. So it became like hyper-normalized, that the fakeness was real and no one believed in it. And I feel that way about the stock market the last 2 or 3 years, that all this money printing, all these stock buybacks, all the cheap interest rates that make stocks look cheaper than maybe they really are, it's like a fake market. But we've now come to think that this is real. That companies driving earnings with stock buybacks is the norm, and it's not. It's hyper-normal. So I think that these policies, which are, number one, look to be driving interest rates higher, ending this era of hyper-normalized cheap money, means that the stock market is going to start having volatility, and it makes these options solutions even better. And if you want to look at it this way, it's already started, but to the upside, that we've seen the biggest post-election rally ever into the inauguration since 1900. Biggest ever. Bigger than any other president ever. So that already tells you that the volatility has started.
No, that's crazy. Yeah, you're right. It's well, we're in a holiday pause, and we'll have to get ready for the volatility to come back next year for sure. Well, thanks.
Yeah, but I think it's going to be a lot more interesting than it was, say, the last 2 years. Regardless if it's to the upside or downside, it's going to be way, as a trader, I think it's going to be a lot more interesting, a lot more fun.
Oh, for sure. And you're seeing sectors kind of do their own thing, too, separate from the averages, more so now than you have a couple months ago. Well, I know you got to go, so thanks for taking the time to talk to me and everyone else, and we'll keep in touch.
Yeah, thanks for having me.